Hello, welcome to the next in our series of videos on IFRS 9 for corporates. I'm Sandra Thompson. I lead our Global Accounting Technical Group for Financial Instruments. I'm here today with Claire Howells. Claire's in our UK technical team, but she's been helping many of our UK corporates as they implement IFRS 9. If you've been watching the others in our series, you know that so far we've dealt with the classification and measurement requirements in IFRS 9 and impairment. Today we're going to move on and start talking about hedge accounting. This is the first in a series of videos on hedge accounting. Today we're going to go right back to the basics because we know this is an area that many people find tricky. We also know that some companies actually avoid doing hedge accounting altogether because it is quite hard to get it in some cases. And the ISB itself has recognised that. And one of the good things about IFRS 9 is it simplifies the rules for hedge accounting, so it's easier to get hedge accounting. Before we talk about hedge accounting, can you tell us what hedging is?
So hedging is a way of managing financial risk. Most corporates do so. Examples would be holding cash in a foreign currency so you can pay foreign currency expenses, or taking out a forward contract to fix the amount of cash that you will pay commodity price wise or foreign exchange wise, or perhaps taking out a swap to fix or unfix the interest rates on your loans. That's all a form of hedging.
Okay, so that's hedging. So then what's hedge accounting?
So hedge accounting takes away the P&L volatility by actually changing the accounting for the underlying items, the cash, the swap, the derivative, the purchase or the sale.
Okay. So I guess that means if you don't apply hedge accounting, you get P&L volatility even though you've mitigated risk. And in fact, I've seen some companies that in their income statement have reported profits before volatility from hedging derivatives. That doesn't sound ideal.
That's right. It would be nice if we could get companies reporting the statutory profit or the profit according to the accounting standards. But a lot of companies didn't do that because IFRS9 had quite strict rules and it was complicated to apply hedge accounting.
So Claire, can you give us an example, and in particular, how does IFRS 9 make life easier?
So one of the difficulties in IFRS9 was the effectiveness testing, and there was a famous rule, 80 to 125%. So if the fair value movements on your derivative moved by more than 80 to 125% compared with those on the hedged item, you would fail hedge accounting completely. All the P&L volatility would remain despite those efforts to get hedge accounting. Under IFRS 9 we moved to an economic relationship. Now, if you've got a very simple hedge, you're taking out a derivative of 100 to match a purchase of 100 in a foreign currency, then it's clear there's going to be an economic relationship. In some circumstances it may be a bit harder to prove that. The correlation may not match perfectly. So there will be some judgment involved and perhaps some interesting debates with your auditors.
Thanks Claire. Anything else companies should know about? What are the other key highlights?
One of the other big ones for hedging was that IFRS9 didn't allow hedging of components of non-financial items. Companies would often say, but this is specified in my contract. I know exactly what my raw material is. For example, if you wanted to hedge purchases of coffee beans, the purchase price might actually be the coffee bean plus the refining costs, perhaps some transport costs. The derivative would be the pure coffee bean. They don't match exactly. And because your hedged item had to be the whole purchase price, you could get a lot of volatility, perhaps more than the 80 to 125% I mentioned before, and so your hedge was failed. It meant that quite a lot of companies didn't even bother attempting to get hedge accounting. Under IFRS 9, you can now specify the component so long as it is specifically identified in the contract, or that's how the market would price this. So it gives an opportunity to hedge the specified risk that you always wanted to hedge all along.
Okay, and we'll cover more of the details on that in one of our later videos. So that's all good news. Perhaps a third point you'd like to highlight for those listening?
The one other thing that again put people off hedging before was volatility from forward points or time value movements on options. Now again, that led to volatility in the P&L. IFRS 9 recognises this and it's introduced what we call a cost of hedging methodology, which allows you to delay those costs and fair value movements on them in OCI until the hedged item affects the P&L. Now this could be really good news, but it does introduce a few complications. Perhaps system changes might be required. So I have actually come across companies that are saying, we like the idea of it, but we don't want to do that much change, and they may well stick with the old P&L volatility or perhaps hedging the forward rate.
Thanks, Claire. And again, we'll go into more detail in one of our later videos so you can see the pros and cons of going that route or not. So that's 3 pieces of good news. Is there any bad news? Well, there's one particular thing I'd like to highlight, and that's the need to update all your hedge documentation. Even for very simple hedges, where the hedge accounting itself has not changed, you'll still need to do this. And this was one of the reasons that Claire set out. So, for example, under IFRS9, you would have had to have designated how you're going to test effectiveness, how you're going to see if you're in that 80 to 125% range. Under IFRS9 instead, you'll have to document why there's an economic relationship. And that at the very least means taking your old documentation and updating it for IFRS9. Claire, one last question for you. I've heard some people say that hedge accounting is now mandatory. Is that true?
No, it's not, thank goodness. There was a suggestion that it would be mandatory to hedge account if you did the economic hedging that I mentioned at the start. However, the ISB moved away from that. So you could continue to economically hedge and not hedge account. But remember, IFRS 9 is all about being in line with your risk management strategy. So if you don't hedge account and you've still got that P&L volatility that you're asking people to ignore, you might get some questions about why.
Thanks, Claire. That's a very interesting point to leave us with. So just to recap, we've gone back to the basics of what's hedging and what's hedge accounting. We've shown 3 key areas in which IFRS 9 makes life easier, and we've reminded you there's one area in which unfortunately IFRS 9 makes life more difficult because you've got to update your hedge documentation. We'll go into a lot more detail on all that we've covered today and more in our later videos. So please do join us next time. Bye-bye.